Coming up next, FAANG stocks. Using multiple types of data dashboards to make better investment decisions regarding FAANG stocks, including insights on Facebook, Amazon, Apple, Netflix, and Google. And what is the next FAANG? Joining our panel today, Milind Sharma, CEO of QuantZ Machine Intelligence Technology, allowing you to evolve traditional stock picking with machine learning enhanced equity smart betas. Alejandro Rojas, Director of Applied Analytics at Parrot Analytics, providing real-time, country-specific consumer demand for thousands of TV titles in hundreds of markets. Michael Lucente, CEO of Precision Alpha, providing machine-learned equity measurements that are not explained by traditional market metrics. And now, co-founder of Market Rebellion, the best options education and trade idea services in the industry. Your moderator, John Najarian.
Hello, folks, and thank you for joining us. I know you're going to enjoy the insights of the speakers that we've got for this particular segment of the BattleFin presentations. And I know that the three gentlemen who are presenting today have already sort of wowed us with what they have presented in the pre-calls. So like I say, I think you're going to be pretty taken with exactly how they do what they do. If you'd like to, of course, this will be posted up. The full presentation will be posted up to all of you who have registered. So we really appreciate you joining us. And with that said, I'm going to basically introduce all three of our speakers. We've got Milind Sharma. He is the CEO of QMIT. We've got Alejandro Rojas, Director of Applied Analytics at Parrot Analytics, and Michael Lucente, CEO of Precision Alpha. And we've had very positive comments from members of this group in the past. I'm sure this will not be an exception. And here we go, getting started with Milind Sharma. So, Milind, thank you for joining us today, sir. How are you feeling?
Awesome. Well, great to be here with you, John, and hope to be live with all of you at BattleFin sooner than later.
Oh, I look forward to that too. And Milind, for some of the folks who have not seen you at a prior BattleFin, could you give us a little background on yourself before we get into some questions, sir?
Oh, absolutely. So I've been around for about 25 years running hedge funds, mutual funds, prop desks at the usual names of Merrill Lynch and RBC, Deutsche Bank, and all of that before I launched my fund. Most people know us as QuantZ Capital, the Stat Arb Fund. It's been around for a dozen years now, and more recently, in the last couple of years, we've actually pivoted to being a signal provider. So we've actually taken what we were doing for a long time, which is factor investing, and sort of turned that large factor library with machine learning sort of enhancement into derived signals that you can either use to invest in thematic smart betas or combine sort of combo multi-factor signals for, market neutral, long, short, whatever kind of investing you wish. So it's sort of reaching out to a broader audience by licensing out those ideas.
Well, so thank you for that. Let's get started with maybe an examination by you, Milind, if you wouldn't mind, about how factor quants have fared in the first half of 2021 thus far.
Awesome. Thank you for allowing me to share a couple of slides here. So why don't we just jump to this first heat map here, because it has actually been truly an extraordinary first half of the year for factor quants. In fact, we haven't seen anything like this since the NASDAQ crash, which put my career on the map. I mean, at the time we'd done rather well in the with the Merrill Lynch funds I was on. And we've seen some truly extraordinary sort of what I'd call the double alpha coming both from the long and short side. Now, this may seem odd because at the beginning of the year, we all remember what happened with Wall Street bets and the GameStop madness. And yet, despite all of that, where, I ran this, I think the slide is from mid-May. when we saw some of the signals hitting 60% year to date. Our flagship Fab 14 is up to 56%. Value plus momentum is up to 60. So, those are extraordinary numbers. That's like 300% annualized. Obviously, that's very anomalous. It's not going to happen all the time. It's not sustainable. But it's noteworthy that, this kind of an extraordinary thing can happen. So the real question is, why did it happen? Right? I mean, and as I mentioned, despite the GameStop madness, what you notice is that actually roughly 1/3 of the returns are coming from the short side. So that's the more interesting part, is that, the shorts have managed to contribute year to date. And maybe if I can jump to the second slide here and just show you what really happened, because in the early part of the year, up until roughly mid-Feb, when the sentiment around the FAANG names changed pretty dramatically, as you got the rate rise, sort of inflation there kicking in, and then all the FAANGs and your Cathy Wood type of names sold off pretty dramatically. And in this slide, I've got essentially the top 10 names in ARC from their filings, and you can see that pretty much all of them were shorts in our model. So this column here, Feb 12th percentile ranks, that's when ARC topped out. And you can see that, like Tesla was 14th percentile, but Teladoc was right at the bottom, 2nd percentile, Unity Software at 3, Spotify at 3, Twilio at 5. So pretty much all of these names were, at the very bottom of our model ranks. And not surprisingly, if you go out and look at the whole sort of liquidation episode, which bottomed out on May 13th, the average drawdown in these names is 35%. So it's actually, that's why the double alpha in the model kicked in, because, it sort of was, the model saw all of this coming, and historically it's had a very strong track record with bankruptcies, all the Krispy Kremes and JC Penney's going back many years. I've seen so many of them having traded this model for over 20 years. But yeah, so it's been truly extraordinary. And, if you just look at the chart of the model scores, against the price action, it's easy to see how this kind of played out in year to date, right? So initially, many of the stocks ran up during the GameStop madness. So here's your Teladoc running up from 200 to almost 300, whereas the model score is still at the bottom, practically at 0, and then eventually it collapses and trades all the way down to below 140. Same thing with Tesla. You get the initial pop, coming right out of the gate this year, and then over time it sort of fades more gradually. So that's kind of been the theme across the board for a lot of the FAANG names that we've seen. And you might say, well, where does that kind of leave us now? And this is sort of one pair trade that I would suggest at this juncture, which is, if sticking with some of these auto EV related names, we've got a pretty high score in Ford right now. So if you want to pair that up with something like Lordstown Motors or Nikola, that's a pretty good pairs trade. Although on the short side, arguably some of the bad news is now out from last week when I first mentioned this name. As you know, the CEO resigned yesterday, the CFO resigned, the company said they may not be a going concern. So a lot of the bad news already out of the stock, but I think it does show that the model has some predictive efficacy on the short side.
Yeah, and by the way, how often do you do these pairs trades? Do you find the correlations are good enough when you start and then trade that divergence?
Well, so we actually just FTP or, transmit in some other manner the entire ranks file, right? So for essentially all of the liquid institutionally tradable US plus Canadian and ADRs, our universe comes out about 2,800 stocks a day. And we just transmit all the alphas as Z-scores, percentiles, and then usually the quants know what to do with that. They plug it into their optimizer, or quantamental folks may look at it with other considerations. So it's not necessarily that you have to do a pure sort of co-integrated kind of pairs trade, right? Like it doesn't have to be pure stat arb. It could be any fundamental value growth PM who just looks at it and says, okay, maybe there's a variant viewpoint here worth considering.
Well, thank you for that, Milind. I'm going to jump to Alejandro Rojas, Director of Applied Analytics over at Parrot Analytics. Alejandro, we looked at some pretty interesting slides from you as well. Would you mind sharing some of that with us now?
Yeah, so let me give you first, before we jump in.
Oh,
I
and a
want to
little
give
background. Sorry about that,
yeah, a little bit of
Alejandro.
background in terms of what we do. We actually built this patented system that tracks audience behavior. So we can actually track thousands of shows in hundreds of countries. And we go to the granular level of we can actually tell you for a specific title, how people interact with it, from a Google search to a Wikipedia visit to even like piracy torrent, which is like many every day. So they have a sense of volume. Like we collect like millions and sometimes billions of torrents. So then like you add everything else, like YouTube watching and all of that. At the end, we have a data set that is just massive. And essentially it's built so that we can track individual titles. So how do we leverage this from an investor's perspective? That's what I want to share today. And I prepare a presentation for this. The particular case that I want to discuss, obviously, is Netflix. And what I want to kind of walk you through is the way we think about leveraging our data to really providing a very simple answer to a question, which is like, are they going to meet their net subscriber addition guidance, So obviously every quarter they have a guidance. What we do is like we actually track, how like their content is doing, not only in the US, but we do this globally. So the big advantage of this is that we have that perspective. So that you have an idea of how this would work and how this looks like, let me just walk you through some of the things that we have found, over time. And then let me just walk you through this. Like, essentially, we say that demand drives subscribers because all of these activities that I was describing serves almost like as a sales funnel, where like all of these activities are gonna end up as being converted, enable you to convert these people into subscribers. When we track this globally, and we're using here like the regions that Netflix defines, so UCAN, EMEA, LATAM, APAC, all of those, we can track on the vertical axis. What you see is the number of subscribers that Netflix has, okay? And on the horizontal axis, what we have is actually our metric, which is demand. And we actually track this on an individual title basis. So every row that you see in there is actually an aggregation. So when you look at the top row, for example, in there, we're looking at the demand of all the original content of Netflix, okay? So we track that demand, we add the demand of every single original over time, and then we compare that against subscribers. What we see in all of the regions, there's a strong correlation. We do the same exercise for like all the exclusive content. So not only originals, but also licensing content that they may have in exclusivity. Again, like the same correlation we find, and that's what you see in the middle of the section. And then in the bottom section, the bottom row, we actually track all the titles. So imagine all the titles that they have in their catalog. We add the demand of every individual title over time, and we compare that against the number of subscribers. We do this for hundreds of countries. What I'm showing you in here is actually a representative sample of how do we track, for example, in the case of UCAN, how do we track the US? In EMEA, how do we track the UK? In LATAM, how do we track Brazil? But in truth, it's like we track all of the countries that belong to that specific region. So essentially, this graph can be replicated across like hundreds of countries. And what you see in here is like every single quarter we're tracking this. What we see I think the line is like, it's clear that, basically demand serves as an indicator of how many subscribers you're gonna have. And that's really the point that we have. And now the next, I guess like the next step is like, how do we leverage that to know if they're gonna meet the guidance or not? And in there, like really what we have done, and again, like I'm also just giving you an example because like this is like a massive model that we can do, but in here, only looking at the US and only looking at the originals bucket that I showed you before, we basically looked out over the last 17 quarters, and we see when like they actually like beat guidance and when they miss guidance. So whenever they beat guidance is the green dots that you see there. Whenever they actually miss guidance, it's the orange dots that you see. And then in here, I'm just giving you some sampling of like some of the metrics that we have. But let's explore one of these so that you guys know what I'm talking about. So in this like bottom corner, on the left corner, we have demand as a share, okay? So really what this is measuring is like, imagine like the originals in the US for Netflix, what is the share that they're getting, you know, in terms of the total demand for the total, you know, direct to consumer market. So that's one number. Then the other number that I'm seeing here is the decay. And the decay is essentially what is the decay of the library of original titles that they have. And by that, I mean, it's like, how much is that has that declined over quarter? These are two metrics that we can combine or we can calculate based on our data. And what you see here, again, then we can start doing analysis and seeing like, when is it that they actually beat their estimates and when is it that they don't? And in blue, I don't know if you see it, but in here, this dot in blue is actually in this second quarter. So what you see is like, if you look at this specific square, again, like it looks like this blue is in the middle of the green section. So it looks like, yeah, they're gonna beat their guidance based on only this, you know, this analysis. If we go on top, again, this is another metric. We look at the mean shift. It means like really is like the average demand for the total catalog, but actually from the last quarter. What we see there is like, if we actually analyze that, then it's a little bit harder to tell if that's gonna be a beat or it's gonna be a miss, right? So again, like these are just examples. We do this like measuring like, you know, like a number of like metrics. So with that, we can create models that basically can allow you to predict. And we have done like, you know, so that you get a sense of like our accuracy. We get like over like 90% accuracy in terms of estimating when Netflix is gonna beat their net ads number. So it's a lot of analysis going into this, very granular because we go on a title by title, but then we actually roll it up. And then based on that, then we can tell you, you know, how Netflix is gonna do. And we can anticipate, you know, what's gonna happen the day of the earnings. And then the last thing I wanna share is like the same sort of metrics that we use for Netflix, we can also use for some of the other streamers, right? Like Amazon, HBO Max, Disney Plus. So with that in mind, essentially now we have a model where we can actually replicate the same thing with all the other streamers. And then we can tell you, you know, ahead of their earnings release, you know, if they're gonna meet their numbers or not. And that's really, I think what's powerful about this is like, essentially, if you think about like the job that we're doing is goes back to the title of the presentation, which I call it now casting Netflix net ads, because really it's not forecasting. We're actually collecting data as we speak, right? So we know if the content is resonating or not. And then based on that, we can tell you if they're actually gonna be able to meet their subscribers figures. So that's really what we do. And it's like, it's exciting to be here and I appreciate the opportunity to share these insights.
So now we've all got a new term too, not forecast, but nowcast. So thank you for that. Michael Lucente is a repeat person on Battlefin. And Michael, we certainly appreciate your sharing your insights of Precision Alpha. Could you give the audience just a brief background of yourself before you start?
Thank you, and thanks, Battlefin. I went ahead and shared my screen with respect to our measurements on Amazon, and I'll just page down to the probabilities we have for Amazon on a given day over the last several months from March until June. My background, I ran a multi-billion-dollar family office outside the United States for about 3 years after I left Merrill Lynch. My partner has a PhD, and he's the smart guy, and in theoretical physics and applied math from Cambridge. His mentor at Cambridge was Stephen Hawking, and our company Precision Alpha delivers daily file feeds of precise, unbiased, machine-learned market signals for any financial market globally using the client's own data or our closing price data. And 90+%, more than 90% of our signal is idiosyncratic. So it's not explained by other market factors like volume or economic data. What we're seeing is pure alpha. And here's the truly extraordinary part. We routinely reveal movements in security prices 1 to 3 days before they occur. I'm going to show you that momentarily, but I just wanted to talk for a moment about how we do what we do. With deep neural nets, random forest, logistic regression, all of these build on the same mathematical machinery of the scientific method. But statistical near equilibrium assumptions are typically made, and numerical algorithms designed that produce numerical estimates for market quantities like probabilities, for example, are estimated. And what we've learned through the scientific work of Marcus Lopez de Prado and others is that financial markets are not in equilibrium. When statistical equilibrium assumptions are introduced, numerical algorithms, estimates are introduced early in the scientific analysis, scientific quantities that we would expect to see, like energy, resistance, power, noise, are out of reach. And estimates on top of estimates hide useful and intuitive market information. Precision alpha also uses the scientific method, but only precision alpha starts by calculating how far a security is away from equilibrium, and equilibrium being a 50-50 probability. You can see Amazon right now, today, is a 50.85% bullish. The green line is bullish next day probability. Once we have a precise next day probability, from there, we calculate the emotion contained in price movement. In scientific terms, the energy driving a security further away from equilibrium or back toward equilibrium. No assumptions are introduced. We let the market speak for itself. Next day probabilities, energy, resistance, all of the fundamental qualities in scientific signal processing are calculated daily. So as a result, we're delivering non-equilibrium market information that is currently completely unavailable to market participants. And what our insights demonstrate is that securities, you can see, Amazon has not been at equilibrium since March 25th. And we see securities moving away from equilibrium for weeks or even months at a time. The critical point is that where non-equilibrium trading strategies are used, they can exploit the non-equilibrium behavior. So let me show you the movement here in Amazon. You can see the security price peaked on April 29th at a price of $34.71. The next day, April 30, still trading essentially at the same level, $34.67. Amazon fell from that point all the way to a bottom of $31.51 on May 12th. That's a drop of 300 points. Amazon, as I said, was trading at equilibrium back in March. You can see that the next day probability is bullish. What did we see in our calculation of energy? On April 29th, we saw our measure of energy bottom. When free energy is declining, and it began declining on March 31st, all the way until April 29th, the security price on a bullish security is increasing. And that's exactly what we saw with Amazon. As soon as we saw the turn on April 29th, and then the next day, we saw free energy change, and free energy reversed for the first time. So now free energy is rising, which will cause a bullish security to decline. And lo and behold, on April 30 and April 29, Amazon peaked and the price began to fall by 300 points all the way until May 12th. Now, what do we see right now in Amazon? You can see that Amazon, the energy is trading in a much tighter pattern. And what our clients are doing right now are selling short-dated calls 2-week calls. They know that not enough energy is being released to drive Amazon away from its current price range, and they're picking up 1.7% as a premium for a future call. What do we see in other securities? Take a look at Facebook right now. Just plug that into our model. Facebook is trading currently at a price of 336. Facebook is at equilibrium, market power of 0, next day probability of exactly 50-50. But Facebook has a tremendous amount of energy that has built up. What you will see is as soon as Facebook releases either bearish or bullish, that energy will be released. And that security is going to run either, if energy drops and it's a bearish next day probability, Facebook is going to run to the bottom. If it's a bullish probability as it breaks out, when the energy is released, Facebook is going to run higher from the current 336 price point. You can see it's clearly 50-50 right now at equilibrium. What do we see? Everybody asks about the broader market. What do we see for the Qs? Let me pull up the Qs. And ETFs are you never know what's in these ETFs, so they're not a perfect estimate. And by the way, you can plug in any security, download a free trial of our app at precisionalpha.com, and you can plug in any security. Of course, our institutional clients get measurements for every single security on whichever exchange they subscribe every single day. So right now, the Qs are trading at 342, yesterday's close. You can see it's a very strong bullish next day probability, 50.85%. Markets are reasonably efficient, but markets are not at equilibrium. They're not 50-50. They're close, but they're not. You rarely see probabilities moving beyond about 53%. But right now you've got the Qs there, but look what you see in the energy. You've seen the price rise in the Qs beginning on May 12 all the way to right now. And what's happening in the energy? The energy for the Qs has bottomed and began to move the other direction. So the energy has been fully released. The price of the Qs should begin to fall. And that's exactly what we're seeing. If you follow, and by the way, when we've calculated energy, until about 6 weeks ago, we were measuring the total energy contained in price movement. We've been able to refine that calculation further, and now we're using free energy, which is a physics term, which is the portion of the energy that is actually doing work to drive the price away from or toward equilibrium. And when you've isolated that, when you've isolated the free energy, it's really an incredibly revealing security. So before I turn it over back to John, I would just like to reiterate that many of our clients upload their own price data to us for any market, and we return our measurements securely and privately. This is faster, more secure, and less expensive, and gives clients the confidence of using their own data. Precision Alpha can complement statistical financial modeling. The scientific signals generated by Precision Alpha can be embedded into other machine learning analyses without introducing additional parameters. We are limiting the number of clients by virtue of the power of our signal. So please take a look at us, contact us at precisionalpha.com. We're pleased to be here today with Battlefin. John, we appreciate your attention and support today. And thank you. I'll turn the screen share back over to you.
Great. Well, Michael, thank you very much for that. We'd love to hear a little bit, Milind, if you wouldn't mind, just quickly as we're wrapping up, about how people could go find out more information about QMIT from what you've done over there as the CEO of QMIT and Quanzi. You're muted, Sorry, there you go.
Does that. So, thank you. Yeah, I mean, we've got a ton of webinars in our website, and we're available for meetings. Hopefully, you can book one through Connect with us, and would love to give you a better sense of how to, how we go about these sort of machine learning enhancements. Because at the end of the day, if you just want to build your own library of factors, you can go to the various sources, the CompuStats and the Bloombergs and FactSets and whatnot. But what we're doing is something very different. We're really taking the basic building blocks and turning it into highly customized sort of signals that can be plug and play. So you can directly plug it into your hedge fund, mutual fund, whatever structure and type of product it may be. And that's what makes it rather different is the degree to which it's customizable, right? Like regardless of your investment philosophy, if you tell us you're a GARP manager or you're a deep value guy or whatever it is, we can make it work that way. But beneath the cover, there's a whole ensemble learner that's going on across different types of, we're doing all sorts of risk parity and random forest and this and that. But the beauty of it is that you don't need to, just like, the iPhone user doesn't need to know how the code's written and how the actual stuff works, right? I mean, we're not trying to overwhelm you with all those details. I mean, the bottom line is if you're a fundamental guy who understands growth and value, you can pretty much understand everything we're doing. The stock picks will make sense to you.
Thank you, Milind.
John, a lot of our clients, what they do is they start with a macro view. They may want to pursue financial stocks, for example, or have a macro view, and then they use the signal to determine entry and exit points. You could see we saw the turn in Amazon a few days before it occurs, and right now it appears the Qs are going to turn south in a hurry. So we'll see how that prediction works out.
Fantastic. Thank you, Michael. And Alejandro, if somebody would want to learn more about Parrot Analytics, how would they connect through Battlefin? But if you want to throw out a site to send them to, that would be fantastic.
I mean, you can go directly to parrotanalytics.com. We, apart from having the data set that I just shared, we actually write a lot of insights in terms of the industry, or where the industry is going. We are in a unique position where we actually see how audiences are reacting to all of these shows are being made available by all of these streamers, and not only in the US, but globally. So in a way, it's an amazing data set to really answer a very diverse set of questions. We work with investors. We also work with media networks. We work with producers. So it's a very diverse set of use cases that can leverage our data set. Very unique in that sense.
Well, I want to thank all three of you gentlemen, Milind Sharma, Alejandro Rojas, and Michael Lucente. Thank you guys for the presentations today. And of course, to our hosts here at Battlefin. Thank you.